So one of the great questions that I get all the time is, when should I consider refinance? That is a loaded question. It's very difficult to address without knowing all of the details about each person's individual situation, what their plans are. For example, if you're a younger couple that is, has young children and cash flow is king, or you're getting ready to retire and you want to take advantage of equity and pay a bunch of things off and limit your liabilities, there's going to be two different answers. Now, it also depends on what type of loan that you have, but you got to compare apples and apples. And one thing that is difficult, because interest rates are a moving target, they change. Just as if, let's pretend you're a day trader or a hedge fund manager. You're going to see that you want to buy things when they're low and sell when they're high, right? So you're watching the stocks and the bonds, and you're managing all sorts of different funds, just like a family does. There's so many different variables just within a family's dynamic. The same thing is true when we're asked about a refinance. So the other thing is, because it is a moving target, that comparing things on one day versus 2 weeks from now, it's going to change. And then the consideration itself might change. So, it's not a decision necessarily that ages well over time, unless you're lucky and rates get better. Now, rates right now are better than they've ever been, and making sure that you compare apples and apples. And when I say that, comparing apples and apples can mean a whole bunch of different things. It could be, if you're shopping a rate. It could also mean if you're comparing an FHA loan that might have a lower rate on the surface but a higher payment because of the mortgage insurance, to a conventional loan, or short-term, long-term. Am I going to keep the house? Am I going to sell it? We're going to ask a lot of questions when we're broached with the idea of making and helping you understand the overall financial ramifications. And that's going to include some things that include both the market, what happens with the future equity, and if you sell the house, how much profit are you going to make? What if you took the same amount of money, because money is so cheap, and reinvested it into a vehicle that's going to pay you twice as much? How does that compare? So we go through a lot of different options to make sure that you understand everything that could possibly impact this decision. At the same time, we're going to try to advise you as to what is the best time based on those circumstances. So if you needed cash flow right now towards the end of the year prior to Christmas, or needed to wipe out some credit cards, it's a fantastic time. If you want to roll in the closing costs and get the prepaid items back and knock out some credit cards before you plan on selling the house in a year and a half, fantastic time. Everybody's situation is different. You could also take that cash flow, the difference in payments, for example, and invest it. If you've got young children like we do, then it's a great time to start a financial strategy to put them through school. If you don't have a retirement plan, for example, or maybe you want to keep the house and invest it, and free up some cash flow, or pay it off quicker because you've got a different business strategy for yourself. So either way, there's really no short answer, but we'll explain all of the details, and I'll put together a series to help you with that, okay?